We went public at Loudeye. I owned about 45% of the company. The company was worth over $2 billion, but it had only $10 million of revenue. So it was worth 200 times revenue. And what happened in the when the dot-com bubble burst, a year later, on paper, I lost over $500 million. But luckily for me, I never fundamentally changed my life. I had a friend that took one of his companies public in the dot-com boom. He had $100 million worth of stock. And the first thing he did is he went out and borrowed a $20 million against his $100 million stock. Well, his company, a year later, the stock price had gone down 95%. He got a margin call and he lost everything. But what the mistake he made is that he actually believed that he had $100 million. Like, I'm a VC now. I've made 74 investments. I got 6 unicorns out of 74. That is about an 8-9% unicorn rate. That is a top 1% rate in the world. So I am batting 8%, and I'm one of the best investors in the world. And I'm still only batting 8%. Like, I have a 92% non-winning rate, and I'm still one of the best.
Today's guest built and scaled 3 venture-backed startups with 2 different exits, including one to Nokia. His first startup was a startup called Loudeye, which he grew from 3 employees to about 450. When he exited it, he had about $110 million in the bank of the company. They IPO'd during the dot-com bubble. He then went on to join Imperium as the first an investor, then a CEO. He raised over $250 million in funding when he was there. Then in 2008, he decides to found a company called Cashless, which then he sold to another startup called Crowd. He's raised over $500 million, so $500 million throughout his career. He's now also the GP of Incisive Ventures, and he also used to work at another venture capital fund called Ignition Partners, where he helped lead the first ever funding round, the Series A of a company called DocuSign, which is now worth $16 billion and has a little over 7,000 employees. So without further ado, I introduce Martin. Martin, welcome to the Builders and Funders Show.
Hi, Burke. Thanks for having me.
Absolutely. Martin, when I was reading your bio, one of the things you talk about is the thing that makes life interesting is finding problems to solve and solving problems. I want to get your take on what excites you about a problem? Why do you pick the problems that you choose to work on?
Well, I think fundamentally I'm a pretty curious person, and I get bored easily. I mean, a lot of people ask me, like, why aren't you just like playing golf and fucking off because you're rich, and you can do that. And it's because I'm curious, and I like having hard problems to solve. I don't think life is interesting if you don't have hard problems to solve. And so for me, problem solving is fun. And I'm not the kind of guy that likes crosswords or puzzles. I mean, for me, listening to entrepreneurs who want to change a business and think they've got a unique insight to do that, that's the kind of problem I like to solve. I've done it pretty well myself. But for me, it's the fact that, you make the world a better place. Like, for example, I've been investing for the last 5 years, basically in B2B software companies. When they have 3 guys and a dog, and they have an idea to make and in my experience, a lot of B2B software can make the world a much better place. You mentioned how I was, one of the early investors in DocuSign. I wanted to correct it a little bit. I did not lead the Series A of DocuSign. I was employed at Ignition Partners. Ignition led the Series A. So I was just one of the team. It wasn't my investment exclusively. But one of the reasons we were excited about that is that you look at what they were doing. At the time, digital signatures were illegal on a lot of documents, but the way of signing something on your phone instead of printing out a PDF file and scanning it and faxing it, the new way versus the old way, it was 10 times better. And you could imagine a world where everybody's signing contracts with DocuSign is a better world than the world in which you had to drive to a notary office and sign something. I mean, it's just a better world. It's a more efficient world. It has less friction. People have more free time to do fun things instead of driving in their car to sign contracts, which was a stupid waste of time. So I like finding those kinds of problems where if somebody's correct in their innovation, the world is a better place. And people can argue whether it was hugely valuable what DocuSign did, but I argue that it is because it freed us up to do other more productive things than sitting in our car and driving to a lawyer's office to sign a contract. Recently in this fund, I met a company early called Deal, Deel, and they were a B2B software company trying to create a better version of an employer of record. The current employer of record at the time that was the leader in the market is a company called TriNet. I had used TriNet. I had employed a lot of people through that. It was 1980s software. It was shitty. It had a very low NPS. It was very hard to use software. Everybody who ever used it was very frustrated. It was a net negative on productivity for many businesses. And I said, you know what? I want to fund these guys at Deal because if their thing works, they can free up people's time. A lot of businesses will be much more efficient. 5 years later, Deal's doing $550 million of revenue. It's worth $13.8 billion. But it's not worth a lot of money just because people are throwing money at it. It's worth a lot of money because their version of this employer of record is 10 times better than the old version, TriNet, and businesses are more efficient the way Deal is doing it. It has made the world a better place because of the existence of Deal. So that's what that I like that kind of challenge. Can you make the world a better place? But not in an ephemeral, maybe there's less carbon, maybe people are happier type bullshit. It's like, how is the core economics of something running, better so we have more time to do leisure things or to invent other things. Um, you know,
Hmm.
less
I was
time in
looking at
drudgery, more time in fun stuff.
Absolutely. I was looking at some of your portfolio. I think you talked about one of the investments you made, which was a software company that was selling to storage unit owners. And when I heard of that, I was like, whoa, that's genius, right? Like they found this niche and they built B2B software that makes their lives easier. You mentioned how that industry, anyone who operates those types of companies, they're really doing pen and paper. They're doing the old archaic way of bookkeeping, et cetera. Now this software comes along and it kind of takes over that entire vertical. If you're a young founder today or even a little older and you're thinking, okay, I want to identify industries like that where I can take my knowledge of tech and my tech savviness and I can solve a problem, I can make life better. How would you go about identifying some of those industries? How do you go about maybe doing the research to find those problems?
Well, I think the worst way to do it would be to read like Gartner and the press and TechCrunch and say that market's going to be big. That is the worst way to do it. The best way to do it is to have some personal experience for and with a problem. The best kind of founders I like to fund are guys who know a particular industry, saw some problem in the industry that caused them frustration operating in that industry, went out, looked at buying everything that they could, tried to find somebody else who was solving the problem, could not find anybody solving it correctly, and reluctantly started a company because they wanted this problem solved for themselves. That's the absolute best. So, for example, the storage unit. I do love, despite how much we have invested in IT, and a lot of people think that we're in this golden age. Everybody has an iPhone in their pocket. Every software has been written. There's plenty of industries that are basically dinosaurs when it comes to technology adoption. Think of agriculture, construction, storage units. I mean, healthcare is still in many ways very far behind. And think about the taxi industry when Uber launched. The taxi industry was people on telephones calling people, on cell phones in their cars, trying to get them to schedule. It turns out software could schedule people to pick people up much more efficiently. There's still those opportunities where industries have a particular way of operating and are not being very efficient. Storage units is one of those industries that is incredibly fragmented. Less than the top five owners of storage unit um, facilities in the country own less than 15%. So there's, the vast majority of storage units are owned by one or two people, own one or two of them. So it's a fragmented market. It has old technology, and nobody is really building for that business, despite the fact that it is a huge business. We spend billions of dollars a year on that. The fact that it's fragmented and makes it hard for other software people to build for it. So I love that. I just did an investment in Latin America called Zella.me, which is a guy building a vertical market software for private security firms. And so here's a guy, his business guy, went to Harvard from Mexico City, went back to Mexico City, ended up getting robbed, leaving his condo a couple of times. And why did he get robbed? It was because his security guy that was supposed to be there on staff didn't show up for his shift. So he started personally looking into why is it that these private security firms can't get people to come and participate in their shifts. He found all sorts of problems in the private security firms of scheduling people, finding employees. He went down the rabbit hole and he learned all about it. And he's like, I think software could help in the same way that software made booking rides easier, booking security guards. He thought he could write software to do that. And it was just something that nobody had ever done. So he started the company doing it. It's working really well. So what I would say to any new entrepreneur looking for a problem is find some problem that you're personally passionate about and that you're passionate that you want to solve it in a way that's not just as a mercenary, like you think you can make money. You have to have some reason to solve it, which is more than money. For example, this guy who just started Zella.me, he wanted to not get robbed at his condo. So he had a personal problem that he was solving that was in addition to hopefully making some money selling software. You need to find some personal problem to solve where you have a personal stake that's more than just the money you're trying to make solving that.
Absolutely. I want to talk about, so your kind of version of doing that was, you work at a little bit of Accenture, Microsoft, you spend a little bit of time there, you got a job, and then you decide to start Loudeye. Love to get the founding story for those that might not know. How did you think, okay, I want to build the infrastructure for digital audio and video to be possible? And then how did you, I think around that time, the internet still wasn't as popular, it seems like. You kind of had to still have some kind of builder's conviction that this was going to be the big thing. So why did you have that? Where did that come from?
So another thing you need when you're starting some new thing is you have to have some meta trends that are adjacent to what you're building that are going to be tailwinds and drive what you're building. Some reason why your particular part of the market is going to get pulled forward by other things that are happening, other investments that are happening. So here's what happened at Loudeye. So when I decided to start Loudeye, basically what I saw happening is Windows Media had just launched. Real Networks was on version 1 of their codec. They were starting to make hay about, you can listen to audio and video on your PC. Yet at the time, you had to buy an audio and video card separate from the PC. Those were additional things that you would buy. Not every PC came with multimedia built in. But what I knew was that the trend for the PC manufacturers would be to include multimedia as a standard part of every PC at some point in the future. So that is an external trend, which I thought would be happening with or without whatever I did, right? So I said, if every PC is going to have it as a standard thing, and you're not going to have a multimedia PC is not going to be a separate thing, like every PC is going to be multimedia. That's number one. Number two, that it was at the beginning of the smartphone. I think the the iPhone was on version 1. I said I could see version 2, 3, and 4, coming and getting much better, and basically everybody wanting to listen to audio and video on their mobile phone as well. So the devices to consume this are going to become cheaper and more standard in the next 2 or 3 years. So then what are the problems if all the hardware is going to be there basically for free? Then what is holding back the industry from being able to supply this demand? Well, the number one thing that was holding it back is that the entire audio and video archive was on a non-digital format. Like every music was on a CD-ROM at the time, or every video was on a VHS or a Betamax, some kind of tape storage format. So what I identify is I said, you know what, there's going to be somebody that has to take all of those legacy media formats and convert them to the new media formats. The second thing that I realized is that there was not going to be one media format, at least in the short term, that was going to be obviously the winner. Because at that time, Windows, Microsoft, and Real Networks were competing. And then there was MP3 on an independent codec side. So I'm like, as long as there's going to be multiple potential digital formats and this huge archive of analog formats that are not compatible, somebody's going to have to be in the middle providing that service to convert the legacy archive, and it's going to have to be a multi conversion thing. So that's why I started Loudeye Technologies, to be that service provider to ease the transition to digital media. But the external, I was betting on some external things happening, like iPhones getting better, multimedia becoming part of the standard PC, and it turns out the timing was pretty good for that. Many times, startups fail just because the timing is wrong. You can have the right idea, but it could take longer for the external events that you're betting on to happen, for example.
Absolutely. And then, as I mentioned in the intro, you found the company. I think it was founded in 2003, if I'm not mistaken. And then in only about 3 years, you grow from 3 employees to 450. You've got
Yes.
$110 million in the bank account. Why do you think you guys were able to grow so fast, and what allowed you to scale so fast? And maybe what are some
Well, we
stories
were
and learnings from the period?
we were part of the dot com sort of boom, and Loudeye Technologies was the last company to go public in the dot com boom. And so we were part of the optimism about dot com, and luckily for us, we were able to go public prior to the bubble bursting.
Hmm. Absolutely. And then after Loudeye, you get involved in another company called Imperium that was doing oil, renewable oils. I think you first joined as an investor, then you become the CEO, a lot like kind of what Elon Musk did with Tesla. And I think you raised about $250 million when you joined Imperium as their CEO. When I was looking into that, I was curious. You build this tech startup, and it's relatively successful. It goes on, it goes public. You make a couple $100 million, and it's got this insane valuation at one point, and then you decide to leave that. And how do you convince investors that you're now the one to build this company and make it successful? I mean, because at that point you'd only built tech startups, you'd only done stuff with the internet. How did you convince investors? How did you raise over $250 million for this startup?
Well, luckily at that time, people were interested in leveraging the productivity advances that people had gotten in software and applying them to other industries. And that's exactly what I was. I was an ex Microsoft guy doing biodiesel. And there were lots of investors that are like, we do believe that technology people can make a difference in physical industries because they're bringing a perspective. And what I just explained to you, like how we're building the refinery using commodity parts, that is a perspective that I gained in the tech business that traditional refinery builders did not have. So this whole idea of if you're good in one industry, you can bring some insights to another industry. Um, that has actually worked over time, and a lot of people wanted that. But you have to come, you have to bring some fresh perspective. They're like, why are you going to be successful building the world's biggest biodiesel refinery where nobody else has? Oh, you've got this perspective from this other industry. So, I mean, investors believed that, and it was in fact true. I mean, you look at the same thing. I mean, what did Elon do with electric cars? Right? He came from PayPal. He was a software guy. How come he can build a car cheaper than anybody else? Because he brought his first principle thinking, his efficiency and productivity thinking from software development, and applied it to car manufacturing, and it has worked. I mean, investors have seen people transition successfully before. That's why.
Absolutely. Martin, a lot of your career, you mentioned with Loudeye, you've got these macro trends you're riding with, again, Imperium, there are these trends where investors are like, what,
There's some
could
macro
we?
trends there too. Yeah,
Yeah, so investors are thinking, okay, well, maybe these people are building stuff in the world of bits, they can take and build in the world of atoms, and
maybe.
there can be a lot of productivity there as well. The common wisdom is that you can't time the market. It's a very difficult thing to do. That's what any investor will say. It's impossible. But what are some ways where you kind of, if you're a founder, you can know, okay, well, if we can, how do you know you're too late or too early to the party? Are there any kind of ways you've picked up on where you could not time the market, but get pretty close to it?
Well, I mean, I've been too early and I've been too late. You can't really time. I mean, timing the market is typically, people talk about that in terms of buying a stock or something like that. What I've never seen that be successful, but what I have seen be successful in my life and in other, entrepreneurs that have made big, created big companies, you have to have an opinion about the future. You have to live in the future, and you have to bring the rest of the world along to the future that you envision. Um, and hopefully, there are meta things that happen around you, and you have to bet on those, and those have to not necessarily timing, but it's more trends. It's like listen to how people like Jeff Bezos talk about his bets. He's like, people are always going to want cheaper products and faster delivery. Those are two trends that he's like are never going to change. So what I'm going to do is I'm going to invest in software that enables people to get things cheaper and faster than is possible through a physical retail store like Walmart. I'm going to bet on those trends not changing, and I'm going to fulfill those trends at a level of customer satisfaction that nobody else can with this software. So the real question is, what are the trends that you're betting on? For example, let's go back to Imperium. The trends that I started the company on was that we were at peak oil. Oil was going to be go up in price kind of forever, and that people were going to want cheaper alternatives that are more environmentally friendly. That was all correct and going in the right direction until somebody in North Dakota invented fracking. And fracking enabled people that were drilling oil wells to get more oil out of old wells. And basically, oil with fracking delevered from $140 a barrel back down to $40 a barrel. All of a sudden, we were awash with plenty of oil. So if the fundamental thing that you're betting on, oil is going to be scarce and expensive for a long time, changes, then also the whole reason for your business can get fucked, right? So, um, you know, you have to have two things that you have to make a bet on some macro trend, and that trend has to sustain. If that trend changes, your startup's opportunity likewise changes. Like what happened with Imperium. Imperium went really well until oil delevered, and the federal government got rid of their subsidy for biodiesel, so the economics of the business turned against it.
Mhm. That seems to be kind of, I guess, one of the lower points in your career where, like, you've got this thesis, but then it completely gets destroyed by some other invention coming to the market. When someone
It can
looks at your
happen.
career, when someone looks at your career at a glance, it's easy to think, you know what, this guy, like, he built three companies, successful, goes and becomes an investor again, does that successfully. It's easy to think, okay, it's kind of been smooth sailing, but often that's very rarely the story. Tell me about, like, the shittiest points in your career. Tell me about the lowest of lows. Tell me about those stories.
Well, I mean, one story that was fairly popular, well published. Loudeye Technologies was the last company to go public in the dot-com boom, and there's always a question of what's the value of a company. I mean, when we went public at Loudeye, I owned about 45% of the company. The company was worth over $2 billion, but it had only $10 million of revenue. So it was worth 200 times revenue. Um, you, I was happy with that valuation, but obviously, plenty of people would say the company's not worth that. And what happened in the when the dot com bubble burst, a year later, most of the dot com companies were worth, 1/10 or 1/20th of what they were a year before. And so on paper, I lost over $500 million. So then the question becomes, did I ever really have $500 million? And did I change my life and stuff like that? That was a pretty tough thing to deal with. But luckily for me, I never fundamentally changed my life. I had friends. I had a friend that took one of his companies public in the dot com boom. He had $100 million worth of stock in one of these dot com companies. And the first thing he did is he went out and borrowed $20 million against his $100 million stock. Well, his company, a year later, the stock price had gone down 95%. He got a margin call and he lost everything. But what the mistake he made is that he actually believed that he had $100 million. If you have $100 million in a public company stock, which is illiquid and you can't trade it because of trading restrictions, stuff like that, you don't have $100 million. So one of the lessons I learned early in my career, because after losing $500 million, was to not believe your own hype, and to not change your uh, lifestyle based on illiquid assets on your balance sheet. Um, that was a hard lesson to learn, but a good one for people to learn earlier. And that can happen to a lot of startups. If your startup is successful and you're the CEO, and it's marked up to a certain amount, it can look like you have a big number on your balance sheet. The problem is you can't sell those shares. So don't change your life assuming you have that money, because until you actually do have the money.
Yeah. Speaking of hypes, do you kind of see the parallels between that period and now with AI, where a company like Poolside raises $500 million, or there are all these AI startups that are raising millions of dollars pre-revenue? Do you think we're headed towards something like that similar where these companies are going to go bust and a lot of
Of
these dollars are
course,
going to be
you're
lost?
going to have lots of people lose lots of money and lots of founders, you know, buy houses they can't afford because their companies are going to go to shit. But, the funny thing is, I've been investing for 30 years. It's always something. There's always some shiny thing. For a while it was crypto, for a while it was, cloud, now it's AI. None of these things have ever delivered the value promised in the short term. Some of them have delivered the value in the long term. Crypto has never delivered, but things like the cloud has, right? I mean, Amazon, AWS, and Google have very big cloud businesses. There will be people who make money in AI. Not everybody will. There will be winners and losers. There will be more losers than winners in AI, for sure.
Why do you think investors don't learn from history to an extent where like some of
No,
these
no,
invest
they do learn. But the reality is that investing is a game of numbers and averages, right? Like, I'm a VC now. I've made 74 investments. I got six unicorns out of 74. That is about an 8-9% unicorn rate. That is a top 1% rate in the world. So I am batting 8%, and I'm one of the best investors in the world, and I'm still only batting 8%. Like, I have a 92% non-winning rate, and I'm still one of the best. This is an industry that is defined by outliers. So people, when you say people learn, what are people going to do? Not invest? I mean, the reality is, for every 10 checks that I write, nine of them are not going to work. But I can't know which one is going to work any better in the next 10 that I write. So I'm still writing, 10 checks a year. Like, this is an industry where it is very hard to predict the outcomes from the beginning. You do the best you can, you make pattern matching, and I think I'm better at it than average. But even being one of the best, I'm still batting less than 10%. So I don't know what you mean when you say investors don't learn. Investors learn, they hopefully get better over time, but you still have an incredibly low success rate, even as a top investor.
What do you think is, or why do you think you've got a 8% success rate with your portfolio?
Um, well, because I think I'm good at it, because I think I have a better pattern matching engine than people who've only been doing it for 5 or 10 years. And I'm doing it in a specific area, B2B software that has, you know, if you look at the percent of companies that are successful in B2B versus B2C versus biotech versus hardware. I mean, B2B software is has a higher uh, success rate than average. I'm pretty good at it, and I'm in a category that has traditionally done better than average. It's very hard. Um, it's harder to make money in consumer hardware or consumer packaged goods, CPG, for example. If you invested in 100 CPG companies at random and 100 B2B software companies at random, you would likely do better at the B2B software companies because you would have a higher success rate in 100 random B2B software companies than you would have in 100 random CPG companies. So I'm in a good category. I've been doing it for a long time, and yeah, I think that's why I'm
You mentioned
better than
pattern
that.
recognition. What are some maybe patterns? We talked a little bit about what you look on the product and startup side and the idea. What are some things you look at for the founders? What are some patterns that tell you that this founder is going to be able to build something what are some patterns maybe you've recognized there?
Um, I think the big patterns are, for me, are I know a lot of founders won't want to hear this, but second time founders do better than first time founders. And second time founders of where their first thing was a failure versus their first thing was a success. Frankly, second time founders where the first thing was a success do worse than second time founders where the first thing was a failure. Because basically, if you've learned something, so what have you learned? Second thing I look for is, have you proven resilience, the ability to get up after you've been punched in the face. Um, Third thing is, I look for fundamental curiosity, kind of like me. Like I ask a lot of founders, sometimes crazy questions, that have nothing to do with their business, to see if they are fundamentally a curious person. I have found that you look at somebody like Elon Musk. He's got like 10 different companies in 10 different crazy fucking areas. Why? Because he's curious about a lot of things. So founders that are fundamentally curious, regardless of what they're building today, I tend to find have better success in whatever they happen to be building. If people are not curious outside their what they're building, I have found that to be bad. So founders that are fundamentally curious. Another thing I look for is proven ability to tell a story. Um, you have to be able to tell a story that's convincing, to your customers and to your investors. That's where a lot of technical founders fail, is that they know how to build a product and they don't know how to tell a story to convince a customer to buy it or an investor to invest in it.
How do you recommend someone gets better at storytelling? How do you get better at that? How do you perfect that art?
Well, usually I tell technical founders to go find a business co-founder who can tell the story and let them do it. Um, how do you get better at it? I actually took a course from this guy named Robert McKee, who wrote a book called Story Structure. He's basically the number one Hollywood screenwriting coach, and he explains how to tell stories that are compelling. There are people like Robert McKee, um, who can tell you how to tell a story. You can take courses in it.
Absolutely. I always love to ask investors about, you've had to analyze thousands of deals, potentially or hundreds. You've come across a lot of founders. We talked about a few of the deals you've invested in. Love to always, ask about who are some founders that really stood out to you and why, or like startups that stood out to you and why.
Well, one that I particularly like. So I invested in this company, and I didn't invest in this fund as personal investment, but I invested in this company called Catalyst Fitness, and they make an at-home electromuscular stimulation suit, which is basically strength training device, kind of like a Peloton, but Peloton's for cardio, and this is for strength training. So anyway, I met the founder of this company probably 7 or 8 years ago, and they were pursuing what I thought was a poor strategy. They were trying to build this suit, but also build a retail concept and basically charge people $100 a session to use this suit in a studio type format. So it was a retail studio format, trying to get people to come and do workout sessions there, like you would a HIT class or 24-hour fitness or something like that. And I said to the CEO at the time, I love the technology, but I don't like the business model. I think you should sell direct to consumer. And he said, well, that's not what we're doing. And I said, okay, but I mean, here's all the reasons why I think, my idea is better than your idea. And he said, I respect that. He considered it. He continued with his retail strategy. The pandemic comes along and basically kills all retail type businesses. He calls me back and says, you were right. And I think I'm going to pivot and start to go to consumer. So here's a guy who I talked to for 2 or 3 years. He was coachable. He listened to me. He changed his strategy. And not that I was right and he was wrong, but he was open and curious to different ways to get his technology into the market. Um, and basically, when he came back and said, "All right, I think we should do it direct to consumer," then I led around to invest in the company. So what I appreciated was he had a great technology. He just had the wrong business model. He listened to me. He agreed to the new business model. He restarted the company around that business model. I led the round, and since then, they're doing very well. They're going to sell, 20 or $30 million worth of those suits this year. Um, they're doing really well. So what I liked about it is that he had a good product. He had the wrong business model, but he listened to me. He worked with me over time, and I think he now has found a good business model. And I think that's the best thing that can happen between a founder and a VC is, when they can come together after lots of learning in a common plan to attack a market over time, where you've got a real partner, for a 5 or 7 or 10 year journey. And it's not all going to happen right up front, but when you can find that sort of magic partnership where you both respect each other's opinion and learn from each other and pivot and um, you know respond to the market and change your strategy over time, eventually um, you're going to be successful. It doesn't mean you're going to be successful right out of the gate, but that's what you're looking for. Hopefully, in a VC partner, is somebody you can work with and respond to the market over time.
Speaking of fitness, you're also the CEO of Upgrade Labs. You had this video about
I
how this
was.
you were, and you had this video about how you had boosted your testosterone naturally and how that had helped you in so many different ways, especially with your focus and competitiveness. What are some other, well, maybe biohacking tips you've come across that have helped you become more productive in your kind of day to day life?
Um, yeah, I mean, testosterone for men is an important thing, especially after 40. Trying to keep that up, and there are hacks you can do for that, like the Vasper machine that I did, or there's some new prescriptions out there called enclomiphene, which can be really good versus TRT. I think the other one is people should pay attention to their NAD levels. And NAD is a coenzyme in the Krebs cycle. It has to do with your cell's ability to convert fuel into or convert food into fuel to power your mitochondria. But NAD is something that declines as you get older, like hormones do. And doing something to supplement your NAD levels, I think, has been the second best thing I have done in biohacking versus the hormones. The third thing I would recommend is if you have any kind of an injury, and about 3 weeks ago I crashed my mountain bike and broke my collarbone and two ribs. And I'm 60, and it's much harder for a 60-year-old to recover from an injury than it is for a 20-year-old. But there are some things you could do with related to regenerative medicine, and I did some PRF and some exomes and things like that. So I would encourage anyone, especially over 40, to get to know a regenerative medicine doctor. And anytime you have any kind of injury, use some of the regenerative medicine technologies that are out there now, including exomes and stem cells and NAD treatments and hyperbaric oxygen and PEMF and things like that, to heal yourself faster, because the traditional medical system, is actually pretty bad at healing people from injuries as they get older. And there are plenty of things that can help.
Awesome.